Alright, so let's get right into it. The number one question I get asked is, what is the single best way to trade crypto? And honestly, I wish I had a simple, one-size-fits-all answer for you. But the truth is, it just doesn't exist. What works for a day trader looking for quick flips is going to be completely different from what a long-term investor is doing. The strategy that makes a killing in a bull market could absolutely wreck your portfolio when things turn bearish. So, the first thing to understand is that flexibility and finding what works for your personality and your goals is what's most important. There is no magic bullet here, just smart work and a solid plan. The crypto market is basically the financial world's equivalent of the most insane roller coaster you've ever been on. The potential for life-changing gains is very real, and we've all seen the headlines of people turning a few $1,000s into a fortune. But, and this is a huge but, for every one of those stories, there are countless others of people losing everything because they didn't respect the risks. The same volatility that can send a coin soaring 100% in a day can also send it crashing down just as fast. It's a high-stakes environment, and if you go in blind, you're just gambling. But here's the good news. It doesn't have to be a pure gamble. There are intelligent, data-driven ways to approach this market that can seriously stack the odds in your favor. By using what's called technical analysis, which is really just a fancy way of saying we're reading charts and using numbers to predict future price movements, we can make educated decisions instead of emotional ones. When you combine these tools with disciplined money management, you start to trade like a professional, not just a hobbyist hoping to get lucky. So, if you're ready to learn how to do that, smash the like button for the YouTube algorithm, and let's begin. Okay, before we get into any fancy strategies, we have to start with the absolute basics, the foundation of everything we're going to talk about. Think of it like learning the alphabet before you try to write a novel. The first concepts are support and resistance. Support is a price level where a downtrend tends to pause due to a concentration of demand. Like a floor, the price has trouble breaking through. Resistance is the opposite. It's a price ceiling where selling pressure is strong enough to stop an uptrend. Then you have trend lines, which are just lines you draw on a chart connecting the lows in an uptrend or the highs in a downtrend. They visually show you which direction the market is heading. And how do we see this price action? Through candlestick patterns. Each candle tells a story of what happened in a specific time period, whether prices went up or down, and how far they moved. Certain patterns can hint at a potential reversal or continuation of a trend. Finally, and this is crucial, we have volume. Volume shows you how many coins were traded in that period. A price move on high volume is much more significant and powerful than a move on low volume. It's the conviction behind the price change. Mastering these four elements, support, resistance, trend lines, and volume, is non-negotiable for any serious trader. One of the oldest sayings in trading is, "The trend is your friend," and it's a classic for a reason. Trying to bet against a strong market trend is like trying to swim against a powerful river current. It's exhausting, and you probably won't get very far. A much smarter approach is to identify the trend and ride it. The most common tool for this is the moving average, or MA. It smooths out the chaotic price action to show you the underlying trend more clearly. If the price is consistently trading above a key moving average, like the 50-day or 200-day MA, it's generally considered to be in an uptrend. If it's trading below, it's in a downtrend. It's that simple. Now, where it gets really interesting is when you use two moving averages together, a short-term one and a long-term one. For example, a 50-day and a 200-day MA. When the shorter-term MA crosses above the longer-term MA, it's called a golden cross, and it's often seen as a very bullish signal to buy. Conversely, when the short-term MA crosses below the long-term one, it's a death cross, a bearish signal that might tell you it's time to sell or stay out. These crossovers aren't foolproof, nothing is, but they are powerful signals that can help you time your entries and exits to be on the right side of the market's momentum. So we know how to spot a trend, but how do we know when that trend is running out of steam? A coin can't go straight up forever. Eventually it gets tired and needs to pull back. This is where momentum oscillators come in, and two of the most popular are the Relative Strength Index, or RSI, and the MACD. The RSI is an indicator that measures the speed and change of price movements on a scale of 0 to 100. Generally, a reading above 70 suggests an asset is overbought and might be due for a price correction downwards. A reading below 30 suggests it's oversold and could be ready for a bounce back up. The MACD, which stands for Moving Average Convergence Divergence, sounds complicated, but it's really just two lines that show the relationship between two different moving averages. When the MACD line crosses above its signal line, it's a bullish signal, suggesting upward momentum is increasing. When it crosses below, it's bearish, suggesting downward momentum is building. Traders use these tools to get a sense of the market's push. Is the buying pressure exhausted? Is selling pressure getting too extreme? The RSI and MACD give you clues that a reversal might be just around the corner, allowing you to get in or out before the rest of the market catches on. So, the market isn't always in a clear uptrend or downtrend. A lot of the time it just kind of moves sideways, chopping back and forth in a range. This is where a tool called Bollinger Bands becomes incredibly useful. Imagine a moving average line in the middle, with two other lines, or bands, above and below it. These bands expand and contract depending on how volatile the price is. When the price is moving around a lot, the bands get wider. But when the market is calm and quiet, the bands get tighter, squeezing closer together. This squeeze is often a sign that a big move is coming. Think of it like a coiled spring. The tighter the Bollinger Band squeeze, the more energy is being built up for the next breakout. Traders watch for these squeezes really intently. When the price finally breaks out of the tight bands, either to the upside or the downside, it often signals the start of a strong new trend. The bands also act as dynamic levels of support and resistance. Often the price will bounce off the lower band in an uptrend or get rejected by the upper band in a downtrend. It's honestly an amazing visual tool for understanding the market's current volatility and spotting potential breakout points before they actually happen. This next tool might sound a little bit like magic, but it's based on mathematical ratios that appear everywhere in nature, and for some reason, they also seem to appear in financial markets. I'm talking about Fibonacci retracement. After a big price move, either up or down, the price will rarely continue in a straight line. It almost always pulls back or retraces a portion of that move before continuing in the original direction. The Fibonacci tool helps you predict where those pullbacks are likely to stop and reverse. You draw it from the bottom to the top of a big upward move, or vice versa for a downward move. The tool then plots several horizontal lines at key Fibonacci levels: 23.6%, 38.2%, 50%, 61.8%, and 78.6%. What traders have found time and time again is that the price will often find support or resistance at these exact levels. The 61.8% level in particular is known as the golden ratio and is a very significant level to watch. So if you missed the initial big move, you can use Fibonacci levels to find a good lower risk entry point on the pullback. It helps you buy the dips in an uptrend or sell the rallies in a downtrend with more precision than just guessing. We can talk about fancy indicators and strategies all day, but I promise you, none of it matters if you don't master this one chapter: risk management. This is the single most important thing that separates profitable traders from the ones who blow up their accounts. The number one rule is to always know your exit point before you even enter a trade. This is done with a stop-loss order. It's an automatic order you place to sell your crypto if it drops to a certain price, capping your potential loss. Trading without a stop-loss is like driving a car with no brakes. It's not a matter of if you will crash, but when. Beyond that, you need to manage your position size. A common rule of thumb is to never risk more than 1 to 2% of your entire trading account on a single trade. This means that even if you have a string of 10 losses in a row, you've only lost 10 to 20% of your capital and you can still stay in the game. You also need to diversify. Don't put all your eggs in one crypto basket. And finally, you have to manage your emotions. Don't get greedy when you're winning and don't panic sell when you're losing. Stick to your plan. Protecting your capital is your job number one. A strategy is not a static thing. It has to adapt to the overall market environment, or what I call the market mood. There are three main moods: a bull market, where prices are generally trending up; a bear market, where prices are trending down; and a sideways or range-bound market. In a bull market, buy the dip strategies using tools like moving averages and Fibonacci retracement work beautifully. You're looking for opportunities to join the strong uptrend. In a bear market, those same strategies will get you crushed. Here, you'd either be staying on the sidelines in cash or looking for opportunities to short the market if you're an advanced trader. In a sideways market, trend-following strategies don't work well because there is no trend. This is where tools like Bollinger Bands and RSI become more valuable, as you can trade the bounces between support and resistance. Just as important is matching your strategy to your time frame. A day trader using a 5-minute chart cares about different signals than a swing trader using a daily chart, who in turn has a different perspective from a long-term investor looking at a weekly chart. Make sure the tools you're using and the signals you're looking for align with how long you plan to hold your trades. A mismatch here is a classic recipe for frustration and losses. So, we've covered a lot, from the basic building blocks to specific tools and, most importantly, risk management. If there's one thing you take away from this video, let it be this: there is no holy grail or magic strategy that works 100% of the time. Professional trading is not about finding one perfect indicator. It's about building a toolbox of different instruments and learning which tool to use for the right job. The market is constantly changing, and your ability to combine these tools and adapt to the current conditions is what will ultimately define your success. I strongly encourage you, before you risk a single real dollar, to open a demo account and practice. This is called paper trading. Use these strategies, test them out, see what works for your personality. Make your mistakes with fake money so you don't have to make them with your hard-earned cash. Track your results, see what you did right and what you did wrong, and refine your approach. This is your training ground. Treat it seriously and it will pay dividends when you finally go live. Always, always, always prioritize managing your risk. This is a journey of continuous learning. The market will teach you new lessons every single day if you're willing to listen. Be patient with yourself, stay disciplined, and stick to your plan. It's a marathon, not a sprint, but with the right knowledge and mindset, you have a real shot at succeeding in this incredible market. Thank you so much for watching. I really appreciate your time. Smash the like button if you got some value. Subscribe for more content just like this, and I wish you the best of luck on your trading.